Right now, as you watch this, one man is sitting on approximately $400 billion dollars and doing almost nothing with it. His name is Warren Buffett. He is 94 years old, and the strategy he used to build that fortune is not a secret. It never was. He has explained it publicly in plain language for 6 straight decades. Buy great companies at fair prices, hold them, do not panic, let time do the work. That is it. That is the entire playbook. So here is the question that should genuinely bother you. If the method is that simple, if it has been documented in thousands of books, annual reports, and interviews, if the most successful investor in human history has been handing out the map for free for 60 years, then why does virtually nobody replicate the result? Why are there not millions of Warren Buffetts? The answer is not about intelligence. It is not about access to information. It is not even really about money. The answer is about biology, about the specific, measurable ways in which the human brain is structurally incompatible with the mathematical requirements of long-term compounding. And once you understand that, you will understand something far more useful than a stock tip. You will understand the actual terrain you are fighting every time you make a financial decision. Let us start with the most disorienting fact in this entire story. Warren Buffett bought his first stock at age 11. He was a millionaire by 30. By 40, he had accumulated $25 million. dollars. That sounds like a remarkable trajectory. But here is where the story becomes genuinely strange. More than 99% of his total wealth was accumulated after his 50th birthday. The overwhelming majority of it came after age 65. At 66, he had 17 billion. At 72, 36 billion. At 83, 58 billion. Even after donating tens of billions to charity. And now, past 90, over $158 billion. dollars. If you plot that on a standard graph with a normal axis, the first 50 years of his life look like a flat line. Nothing. And then somewhere around his mid-60s, the curve bends vertical and simply does not stop. That shape is not unique to Buffett. That shape is what exponential compounding always looks like when it is given enough time. The math is not complicated. $1 compounding at 20% annually for 60 years becomes $3,700. The same dollar compounding for only 30 years becomes 237. The last 30 years do not just add more, they dwarf everything that came before. The problem is that human beings cannot feel this, not intuitively, not in the gut where financial decisions actually get made. Cognitive scientists have a name for this failure. It is called exponential growth bias, and it is not a personality flaw or a sign of low intelligence. It is a hardwired architectural limitation of the brain. Researchers Wagoner and Sagaria documented it in 1975. When people are shown an exponential curve and asked to project it forward, they do not just guess low, they guess systematically, predictably, always low. The brain defaults to a linear model because linear is what evolution trained it on. The speed of a running animal, the distance to the next water source, the number of days until winter, everything our ancestors needed to estimate was linear. Exponential processes had no survival-relevant analog in the ancestral environment, so the brain never developed hardware to process them intuitively. Researchers Levy and Tassoff formalized this into a precise model. They found that when humans estimate exponential growth, they are unconsciously blending it with a linear projection. Some people blend it at 70% linear, some at 90. Almost nobody processes it as purely exponential. The brain literally truncates the exponent to make the math feel manageable. A striking experiment run by Schonger and Selle during the early pandemic years illustrated exactly how severe this bias is in practice. They gave educated, numerate participants exponential growth data framed two different ways. One group received data as a daily percentage growth rate. Another group received the exact same mathematical reality expressed as a doubling time. Both groups were looking at the same underlying numbers. When asked to estimate a scenario where the true answer was approximately 1 million cases after 30 days, the percentage group gave a median estimate of 15,000. The doubling time group did better, estimating around 256,000. Still wrong by a factor of 4, but dramatically closer to reality. Same data, radically different outcomes just from how the information was framed. The financial implication of this is serious. When someone tells you that your portfolio is growing at 8% per year, your brain hears that as arithmetic. It does not viscerally register that this means your money doubles roughly every 9 years. It does not feel the weight of what that means across 4 decades. And because it cannot feel it, it does not protect it. It sells too early, it trades too often, it treats the compounding curve as though it were a straight line, and it cuts off the very part of that curve where almost all the wealth lives. The same study also identified something called mitigation bias, and this one is particularly relevant to investors. 94% of participants in the percentage group and 87% in the doubling time group failed to correctly assess how much impact a small reduction in growth rate would have over the long term. In plain financial terms, your brain cannot properly feel the catastrophic long-term damage caused by a 2% annual management fee or by the frictional drag of frequent trading. You see the 2% as a small, linear cost. The math sees it as a geometric amputation of your terminal wealth. So the first barrier is cognitive. You cannot intuitively grasp the shape of the thing you are trying to build. The second barrier is neurological, and it is arguably worse because it operates completely below the level of conscious reasoning. In 2007, behavioral scientists Bar Eli and Azar published a study analyzing professional soccer goalkeepers during penalty kicks. They tracked 286 kicks across elite leagues and calculated the mathematically optimal strategy for goalkeepers. The answer was unambiguous. Kickers aim at the center of the net 29% of the time, and a goalkeeper who simply stays in the center has the highest statistical probability of making the save. Despite this, professional goalkeepers, the best in the world, people whose entire livelihood depends on this decision, dove left or right 93.7% of the time. They stayed in the center just 6.3% of the time. Why? Because standing still when the stakes are high is psychologically intolerable. Kahneman and Miller explained this through norm theory. In a high-visibility, high-stakes environment, the social and professional norm is to act. If you dive and the goal goes in, you failed. If you stand still and the goal goes in, you are a coward who did nothing. The emotional cost of inaction is categorically higher than the emotional cost of action, even when inaction is the correct mathematical choice. Now translate that directly to financial markets. The mathematically optimal response to a severe market crash for a long-term investor is to stay completely still, do nothing, keep buying, let the drawdown pass. But the professional norm, the social norm, the norm reinforced by every financial news outlet, every expert on television, every conversation with a worried colleague is to act, to sell, to protect, to do something. The bias toward action in moments of stress is not a character weakness. It is a neurological response, and it runs deeper than most people realize. Dr. Naomi Eisenberger at UCLA ran a now famous experiment using a simple computerized ball-tossing game called Cyberball. Participants lay inside an fMRI scanner and played a game with what they believed were two other human participants. Eventually, those other players stopped passing the ball, deliberately excluding the subject from the game. When participants experienced that exclusion, their fMRI scans lit up in two specific brain regions, the dorsal anterior cingulate cortex and the anterior insula. These are the same regions that process the distressing component of physical pain. The brain did not treat social exclusion as an abstract emotional event. It processed it as a physical injury. The evolutionary logic is clear. For our ancestors, exclusion from the group meant death. So the mammalian brain hardwired social rejection directly onto the physical pain circuitry to create an alarm powerful enough to demand immediate action. Now map this to financial markets. When the broader market is surging on speculative assets and you are sitting in boring, unsexy index funds watching your colleagues report massive gains, your brain does not experience that as a philosophical difference in strategy. It processes it as social exclusion. The dorsal anterior cingulate cortex fires. The anterior insula activates. The fear of missing out is not metaphorical. It is a registered physical discomfort in the central nervous system, and it is demanding that you conform, that you join the herd, that you make the pain stop. Genetic research confirms how deep this goes. Individuals carrying a specific variant of the opioid receptor gene, known as the G allele of OPRM1, who are clinically known to have higher sensitivity to physical pain, also show significantly greater neural activation during social exclusion in the cyberball task. The same biology that makes someone more sensitive to a broken bone makes them more sensitive to being excluded from a bull market. There is even pharmacological evidence. A controlled trial showed that participants who took acetaminophen, a standard over-the-counter painkiller, for 3 weeks showed measurably reduced neural activation during social rejection experiments. A literal painkiller reduced the measurable anguish of financial exclusion. This is the trap. Your brain is running ancient survival software in a modern financial environment, and the software cannot tell the difference between being left out of the tribe and being left out of a cryptocurrency rally. It treats both as mortal threats and it responds accordingly. Given these two forces, exponential blindness and the neurological intolerance of inaction, the obvious question is, how does Buffett actually do it? How has he maintained this discipline for 6 decades while markets crashed, bubbles formed, and the professional norm of activity screamed at him to do something? The answer is not willpower, it is structure. Researchers Frazzini, Cavalier, and Pedersen published a landmark paper called Buffett's Alpha in 2013, in which they systematically decomposed his returns. What they found was not magic. When they controlled for known risk factors, specifically his preference for safe, low volatility stocks and high quality profitable companies, his statistical alpha, the portion of returns genuinely attributable to superior skill, became statistically insignificant. What they found instead was leverage. Buffett consistently applies roughly 1.6 times leverage to his capital base. For almost any other investor, maintaining that leverage ratio would be lethal. A severe market crash triggers margin calls. Margin calls force you to sell at the worst possible moment, converting temporary losses into permanent ones and permanently breaking the compounding chain. Buffett does not face margin calls, and the reason is insurance float. Here is how it works. Berkshire Hathaway owns massive insurance companies, including GEICO, General Re, and National Indemnity. When you pay an insurance premium, that money does not sit in a vault waiting for your claim. The insurer holds it and invests it during the period between when the premium is collected and when claims eventually get paid out, which can be years or even decades later. That pool of money being held and invested is called float. By the end of 2024, Berkshire Hathaway held $171 billion in insurance float. But the float itself is only half the story. The other half is the cost of that float. Most insurance companies operate at an underwriting loss, meaning they pay out more in claims than they collect in premiums. They accept this because they earn investment returns on the float in the interim. But Berkshire's insurance operations are underwritten with such discipline that the company routinely earns an underwriting profit. The float does not just cost nothing. Historically, it has had a negative cost. Berkshire is being paid to hold other people's money and invest it. This is the structural firewall. Float is not margin debt from a broker. It cannot be recalled. It does not trigger during a crash. When equity markets collapsed in 2008, Berkshire's capital base did not evaporate because panicked shareholders or margin clerks demanded it back. The insurance float stayed put, fully invested, and the mathematics of compounding continued completely uninterrupted. The comparison to a retail investor attempting concentrated stock picks with broker margin is a comparison between two entirely different games. The retail investor is playing a game where a single bad year can produce a forced permanent loss. Mathematically, a portfolio drawdown of 50% requires a subsequent gain of 100% just to return to the original starting point. An 80% drawdown requires 400%. A 95% drawdown, the kind that befell infamous concentrated retail bets like Valiant or Wirecard, requires 1900% just to break even. Almost no individual stock recovers from that depth. Buffett built a structure that makes those kinds of drawdowns operationally impossible. That is not temperament in the folk wisdom sense of being a calm person. That is architecture. But architecture explains the vehicle, it does not explain the driver. And Dalbar, the research organization that has tracked actual investor behavior since 1994, quantifies exactly what happens when average investors sit behind the wheel of that same vehicle without the structural protection. Over a 20-year annualized period, the average equity mutual fund investor earned 4.67% per year. The S&P 500 returned 8.19% over the same period. That 3.52% annual gap is not explained by bad stock selection. It is explained by timing errors, by selling at the bottom out of panic, by buying at the top out of FOMO, by every neurological force described in this video operating on a portfolio in real time and destroying its compounding trajectory. 3.5% per year sounds modest. Compounded across 30 years on a meaningful capital base, it is the difference between financial independence and not getting there. Warren Buffett himself has said it repeatedly across decades and in every possible format. The most important quality for an investor is temperament, not intellect. Most people have interpreted that as motivational wisdom. It is actually a precise neurological statement. Temperament, defined rigorously, is the measurable capacity of the prefrontal cortex to maintain top-down inhibitory control over the amygdala during acute stress. Under normal conditions, your prefrontal cortex, the most evolutionarily recent part of your brain, handles executive function, probability assessment, and the suppression of impulsive action in favor of delayed superior rewards. But when markets collapse and every signal in your environment screams danger, the amygdala, the ancient fear detection center buried deep in your medial temporal lobe, initiates a fight-or-flight cascade that short-circuits prefrontal control. The lizard brain seizes command. And the lizard brain does not understand compound interest, it only understands escape. Caltech neuroscientists demonstrated this directly by studying patients whose amygdalae had been completely destroyed by a rare genetic condition. In monetary gambling tasks, where the mathematically correct choice was also the emotionally uncomfortable one, these patients made the rational decision at a significantly higher rate than healthy subjects. Remove the fear biology, and the math becomes easier to follow. The neurobiology of financial disaster is not a metaphor, it is a measurable, mappable physiological event. So here is the final, honest picture of the Buffett Paradox. The strategy is real, the mathematics are sound, the playbook is public and has been for 60 years. The results, when the strategy is actually followed, are among the most well documented in the history of financial markets. The paradox is not the strategy. The paradox is that executing the strategy requires you to repeatedly do things that your nervous system experiences as harmful. It requires you to sit still when every biological signal in your body is screaming to move. It requires you to endure what your brain registers as social exclusion, while a speculative mania rages around you. It requires you to feel nothing when your portfolio drops 30%, trusting a mathematical curve your intuition fundamentally cannot see. And it requires you to either build a structural firewall that removes the possibility of forced selling at the worst moment, or to develop, through genuine, deliberate practice, the rare capacity to override those biological signals repeatedly over decades. The map has always been available, the terrain is inside you. And that is precisely what makes the Buffett paradox so difficult and so worth understanding.